Hello everyone, welcome to This Week in the Markets. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regard to your objectives, financial situation, and needs. Welcome to This Week in the Markets. Today we will revisit Cyprus, cover events at the Bank of Japan, and see what effect these are having in the markets. Cyprus has reached a draft rescue plan with the EU and the IMF that would divide the nation's banks into good and bad categories. The proposal involves shifting deposits below 100,000 euros from the Popular Bank of Cyprus to the Bank of Cyprus. Uninsured deposits above 100,000 euros would be held and would face a heavy levy. The plan effectively shuts down the Popular Bank of Cyprus. Furthermore, rumors out of Italy are that ratings agency Moody's will downgrade the nation again, which would eventually build on risk aversion and fear-mongering trends in the markets. Dutch Finance Minister has confirmed that the Cyprus plan is a template of how to recapitalize banks, effectively drawing a line in the sand that risks must be shared by shareholders. However, the Eurogroup trumped the minister by saying that Cyprus is a specific case with exceptional challenges. The move essentially sets a precedent, and if more of these methods are utilized on Spain or Portugal, then certain risks will be seen, and the bears will overrun the euro, and we will see a mass deterioration of confidence in the currency. In Japan, Governor Kuroda stated that purchasing long-term JGBs are a tool to push down on interest rates. The move would see the bank purchasing 5 years to maturity bonds as opposed to the current 3-year bonds. Now, the policy of expanding their balance sheet would essentially push down the borrowing costs, risk premiums, and yields. Utilizing such a policy will have its drawbacks when the bank eventually has to clear its balance sheet, if it ever wants to. To see how the euro events are playing out in FX markets, historically, the euro dollar has rallied to 1.6 from 2000 to 2008, and this has since then consolidated between 1.5 and 1.2 with a series of double tops and low highs. A 50% Fibonacci retracement will take it to 1.21, a level that has provided support before. Further levels of support at the 61 and 76% retracement levels are 1.12 and 1.01. respectively. Deterring fundamentals will likely spur big bearish moves to these levels, and these may add to the Eurozone risks and the use of OMT by the ECB, which will devalue the currency. Currently, the Euro area inflation stands at 2%, and still with several countries deep in budget deficits, creating more inflation might be the only option. This will consequently devalue the currency. Recent events have also affected the S&P 500. The start of the Cyprus events caused markets to open lower, but since then traded sideways on the back of various data releases. Yesterday the chart formed a hanging man candlestick, so if tonight's session falls further to at least fill up the smoke on the candle, then that will be a stronger bearish signal. A double top may also be in formation as we speak, or I speak, however, only time will tell. The MACD has also formed a divergence pattern while the index has progressed higher since the formation of the first high, which often translates to a signal of a bearish run coming up. In gold markets, an interesting analysis can be seen in the trend of central banks buying gold. Since the beginning of the financial crisis in 2008, central banks have been buying gold, and in 2012, approximately 31.75 thousand tons have been added to central bank reserves, excluding China. Given the fact that the precious metal is a profitable hedge against the fall of the US dollar and inflation, it is a very efficient way of building sovereignty in the event of a global black swan. With the US running the monetary printing press over time for the past few years, it's no surprise they want to hedge their bets. To further emphasize central bank buying, the banker to central banks, the Bank for International Settlements, is the third largest buyer of gold. Now, it's pretty clear that they know something. And guess what? We do as well. The dollar will move lower, unimaginably lower. And as you can see, actions by central banks are more reliable than their words. The message here is only getting stronger. Buy gold. At your discretion, of course. That's it for this week's presentation. Feel free to leave a comment or do let us know if you would like us to cover anything in particular. Happy Easter and happy trading. Thank you.